It's day 2 of our coverage here from Mines and Money, New York City. And joining me now is Dan Oliver. He is the founder of Myrmikan Capital, which I just learned means ant in Greek.
Correct. Ancient Greek. Okay. Correct. I did 4 years of ancient Greek, and this is what I got out of it.
Okay, why ant though? Why'd you call it ant?
2 reasons. One is Herodotus wrote of ants the size of foxes digging up gold in Persia. And people thought this was a myth until in 1996, 2 French explorers found marmots, which in ancient Persian were called mountain ants, burrowing in a gold-bearing strata of sand. They come up, and the villagers take the gold dust off their whiskers. So Herodotus did it just right, and I'm interested in the junior mining space. And like an ant colony, you know, not all companies make it, but the ant farm moves on.
So forget artificial intelligence. Maybe this is the way to go to find new gold sources.
I think, well, there are different techniques of having ants and looking what they dig up and that kind of thing.
So interesting. Well, Dan, you were also on my gold panel, and I just had Chris Mancini on, and I was saying, geez, guys, what's with the pessimistic outlook on gold?
Yeah, sentiment is a counter-indicator, right? So if the sentiment in the panel of gold experts was as low as that, we must be near the bottom.
You used the word dire, Dan.
Well, I did. I mean, it's dire in that it seems so horrible, right? I mean, I think the whole gold community has been waiting for, 5 years to break through 1350. And we keep having these near misses, and everyone's excited it's going to happen, and then it doesn't. And it's just so awful when it doesn't, right? And here we are again, the Fed is delaying or canceling its rate hikes and canceling the taper, getting rid of its balance sheet. Gold should be flying higher. I mean, given the debt and all the problems in the U.S., and here we are going down again. And so it's a tough mentally. It's a very tough space mentally, as you know. It's incredibly volatile, and hanging on in these moments is tough.
But there is a silver lining, perhaps.
Well, yes. I mean, I think one of the problems of the gold thesis is once you get it, it seems so obvious that you tend to over-allocate capital to it. I mean, countries, you look back thousands of years, and in more detail, there are hundreds of examples, last couple hundred years, of governments that deficit spend and their currency tax. It's just that simple. And over the long period of time, it is that simple. The problem is, over a short period of time, it's not simple at all. Gold is incredibly volatile. In fact, if you look at the gold price performance in Weimar, Germany, when it should have been pretty obvious that gold price in German markets was going to the moon, and it did, but the monthly volatility kept getting higher. Right. So it became harder and harder emotionally to hang on to the gold price, even as the currency was going to zero.
Right, and no, I'm happy you bring up the currency point, because even though gold, perhaps is not performing its best in U.S. dollar terms, we're seeing it at record highs in priced in other currencies.
Well, that's right. And again, one thing that I forget sometimes, but the reason why mankind has used gold as money for 4,000 years is because it is the most stable element in terms of value that there is. So it's not really gold prices moving around; it's the dollar prices moving around.
And then that said, Dan, and one thing that came up in the panel is that even though, of course, we'd all want a great gold rally, but you can still make money in the space through gold equities, for example, and picking those winners. So how do you navigate the mining space here?
Yeah, I mean, look, you can do it. It's very tough when gold is falling, because obviously gold mines, as an industry, as a sector, is very levered to the gold price. So that's hard, and that's not really what I do. There are people who look at the rocks and make those sorts of decisions. The way I approach the gold mining sector is that it really is insurance. It's insurance against the failure of Bernanke's monetary experiments.
Do you do that with the mining sector?
Yes, precisely, because the junior space that I'm in tends to be undercapitalized, they tend to underperform, and they tend to have management challenge issues, right? And so they go. So it's like a premium. You pay a premium on your house or fire insurance. You hope you lose the whole thing.
No, but I'm surprised you're not doing that with physical bullion, because the juniors are so speculative.
It doesn't have the leverage, right? The point is, you pay a little bit of money to buy fire insurance to your house. If your house burns down, it's going to pay off at 100 or 1,000 at one, right? And junior mining companies are exactly the same thing. You pay a little money. You tend to lose money over short periods of time, but then if you hold them, when the music stops on the global credit bubble, you can make 20, 30, 40, 50x, right? And that's why you hold them. It happened in the 30s, it happened in the 70s, it started to happen between 08 and 11, it's going to happen again.
But as you and I both know, picking those winners.
Well, but the point is that when gold launches higher, and it's not going back to $1,900 an ounce. It's going to $3,000, $4,000, right? They're all going to be winners. It's be a matter of degree. Which ones win more? Which ones win less? And that's important, right? But the whole sector's going to go bananas when that happens.
Can you give us a pick?
No.
I have to sign up for your newsletter. Really? Yeah. Not one?
I can't do it.
Ay, Dan, you're breaking hearts here. All right. Well, thank you for coming on the show. You're writing a book.
I am.
Okay, so you'll come back on next time.
On the history of credit bubbles, and by the way, nothing has changed for the past 4,000 years.
All right, Dan Oliver, thank you so much, and thank you for watching. We'll have more for you on Kitco.com. No pick, really.